Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 113 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be particularly useful to you in your long-term financial journey. Today, we are going to continue the theme of the week, which is books that I think you should be reading in 2021 that can help you with your personal finances. And the book that I'm going to talk about today is The Little Book on Common Sense Investing, written by John Bogle. And this is a fantastic book. I actually read it for the first time last year, but it has some principles in it, specifically those of investing, that are absolutely timeless, and some good statistics and some good information that can really help especially the beginner investor, move along in their investing journey and know what they need to do in order to build wealth over the long term. And so I think this can be a really useful book for all of you, and we'll talk about what it entails in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below as we go through this episode, and I'll be sure to get back to you there. If you're listening on Apple or Spotify podcast, then leave me a review and subscribe on either one of those platforms. Follow me on social media at MNO with Dylan, Instagram, Facebook, Twitter, all of the major social media platforms. You can find me there and just go click that follow button. And then if you need somebody to help you walk through your financial life, somebody to create a financial plan that is uniquely suited to you and your family and to help you stay accountable to that plan, I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So again, I know there are a lot of you who want to read more in the new year. You want to read more in 2021, and I can definitely help you in that pursuit by giving you some books that are going to help you in your personal finance journey. And one of those today is The Little Book on Common Sense Investing. We've already talked this week about The Total Money Makeover by Dave Ramsey, fantastic book. And we've also talked about The Intelligent Investor by Ben Graham. And I've got a couple more for tomorrow and Friday that I think you guys should be reading as well. But today's book, The Little Book on Common Sense Investing, was written by John Bogle, or many call him Jack Bogle. And Jack Bogle, for those of you who do not know, was the founder of the Vanguard Group. And many of you have heard of Vanguard. Vanguard is one of the largest brokerage firms, investing firms in the world. And he was credited with creating the first index fund. So obviously you can see where his heart is. His heart is in passive index investing. And that becomes obvious not only when you read this book, but when you look at the type of funds that are offered by Vanguard on their site now. You go and look at their mutual funds and ETFs, and a large number of them are passive in nature. And one of the things that Bogle always preached was keeping costs low. And so it is also no surprise that this book, The Little Book of Common Sense Investing, is going to spend a lot of time in that same place. But it covers many main ideas of investing that I think we should all keep in mind. And it also speaks more toward fund investing than did The Intelligent Investor. So I think it also adds something to our knowledge that The Intelligent Investor does not do. And it also provides us with a lot of newer market history than The Intelligent Investor did, because The Intelligent Investor was written in 1949. So that's a bit outdated as far as some of the data goes. But The Little Book on Common Sense Investing is a little more up to date and will help you to make decisions in today's investing climate. But Jack Bogle was a fantastic man, was a fantastic investor, and liked to just disseminate as much information as he could on the investing public. And you can go listen to many interviews of him on YouTube and things like that, where he just goes through everything. He leaves no stone unturned when telling young investors and just investors as a broad group what he believes is the right way to go about investing their money. Sadly, Jack is no longer with us. He died at age 89 back in 2019. But the principles that he leaves in this book, the principles that he has left in some of his other books, and all of the wisdom in the words and interviews that he has left behind. And the legacy of the Vanguard Group and the index fund will forever live on in his honor. And so everything that Jack Bogle has done, I believe, is timeless. And you notice that that is a recurring theme of the books that we are talking about this week, is that I think that the principles that you learn within these books are timeless principles. I don't want you to just learn things that are going to help you now. I don't want to just have you learn things that are going to help you in the short term to make short-term profits, because we are not short-term investors. Short-term investors don't really exist. It's either long-term investors or you're probably speculating in the short term. And so in order to be a proper long-term investor, we need to have that long-term view. We need to have our mindset on timeless principles and not have to just go and swing with the flow of the investing climate from time to time. So I think that this book will really help in that way, in the fact that it is timeless, and the principles that you are going to read within this book can stick with you for many, many years to come. Now, what are the main ideas of the little book on common sense investing? Well, the first is that over the long term, stock market returns are created by real investment returns earned by businesses. This is the annual dividend yield plus their subsequent rate of earnings growth. So in investing, the winning strategy is owning businesses, not trading stocks. So this is a commonly held ideology of individuals like Warren Buffett, where he's like, I am buying a business. I'm not just buying a stock. I am looking at what this business is creating, the dividends that this business is paying out to their investors, and the earnings growth of this business. And that is what is going to create the actual investment return that you receive over the long term. Even though there is speculative return, when it comes to people buying up a stock for any given reason. That is not what's going to drive the stock over the long term. What drives the stock over the long term is real business fundamentals. And then another main idea is that individual businesses come and go. And given the rapid changes and competitions that we face, the failure rate of individual business is high. And there's no way to assure success by picking the funds that will beat the market. The best protection is the broadest possible diversification through all market index funds. And this obviously opens you up to exactly what Bogle is about. Bogle is about broad diversification. He is about buying index funds, buying passive funds, and not attempting to beat the stock market in some active fund that you could purchase, or trusting some hedge fund manager or portfolio manager to outpace the market. He does not believe in that. What he believes in is buying the passive diversified funds and holding on to them over the long term, which I believe is a very good idea. And I've talked to you time and time again that most of what I hold is passive funds. But I do buy some individual stocks, and I don't think Bogle would like that very much. But again, each of the things that we learn from these books, we can take and incorporate them into our own lives, but they don't have to be everything that we are about either. And so the third main idea of the little book of common sense investing is that as a group, all investors in the stock market earn its gross returns minus the costs of financial intermediation. So this is things like commissions, management fees, and the like, and then taxes. And so all this is saying is that everybody who owns the S&P 500, or everybody who owns index funds, mutual funds that are very similar to an index, things like that, are going to get the gross returns of the market less any costs of intermediation, which that means any costs towards a broker or an advisor, and then taxes. And something that Bogle is really, really headstrong about is minimizing your costs, because it is no surprise that a couple of percent, or less than 1% or 1%, 1.5%, whatever you may be paying to a financial advisor right now, will eat into your returns when compounded over time. It is outrageous how much just a small percentage can eat into returns over time. And so he goes very deep into how much costs can actually cost you over the long term in this particular book. And so that's a really useful thought process to have, because I agree wholeheartedly with Jack Bogle in this way, in that I don't want to be paying for advisors. I don't want to be paying for any type of management fees or any type of commissions or things like that. I want to be minimizing those things. And obviously, we want to be minimizing our tax burden as much as possible as well when we are investing. And then the last main point of the Little Book of Common Sense Investing is that market timing and fund selection often lead investors to do much worse than the market. And he runs some comparisons between the S&P 500 and these particular funds that you may try to select that are actively managed, or these individuals who try to time the market and time the certain activities of the market or the certain ebbs and flows of the market, and finds that if you just hold the index, you would have far outpaced those who try to do those types of things. And so that is also no surprise to us, or those of you who have watched this show for any period of time. You know that I have laid those concepts out for you previously. And so let's just dig in for a second into a couple of the ideas that Bogle has in his book. First of which being that costs are the enemy of investing. And so, all investors as a group must earn the market return, but that is only before costs. And so he's saying, as a broad group of investors, we will all end up earning whatever the return of the market is, but only before the costs of investing are deducted, because obviously those are taken out and those don't stay in those returns that we're making. So the gross returns are the returns of the sum of all investors. But if you look from 1980 to 2005, the return of the S&P 500 averaged 12.5% per year. Not too shabby. During that period, the average mutual fund earned 10%, while an index fund tracking the S&P earned 12.3%. Because obviously there are some costs to index funds, and we've talked before about how those costs are typically less than those of mutual funds and other active management techniques. And so Bogle argued that the difference in investing costs are the main reason that the average mutual fund lagged the index fund. And again, no surprise. If a mutual fund is going to charge you, 1%, or if they're going to have really high front end loads or back end loads, which we've talked about previously, these percentage amounts that you have to pay on the front or back end of buying or selling the mutual fund, then obviously that is going to eat into your returns. And it's not surprising that when that occurs, it really eats into your returns, and those higher returns of the passive management of the index fund are because those things don't exist with those index funds, because they are very, very cheap. They are very, very low cost. And so you may say, well, there's really not that much to active management that I'm ending up paying. How much am I really paying when it comes to active management? Well, Bogle argues that if you invest in actively managed funds, you will pay approximately 3 to 3.5% annually. And these costs include things like the expense ratio, which we've talked before, which is just a percentage of the assets under management, the cost of portfolio turnover, and taxes on realized gains. Because actively managed portfolios, actively managed mutual funds are going to realize gains and create tax events for investors, even if that is not what the investor wanted. It can still occur because there is more turnover, and obviously passive funds, S&P 500 funds, things like that are not going to have that type of turnover. And so some managed funds might have additional sales charges, like I said, the front end or the back end or certain commissions. But if you invest in index funds, the costs are only around 1% annually. And here, again, we're just talking about expense ratios, the cost of portfolio turnover, the capital gains tax, and things of the like. Obviously, the expense ratios of most index funds now are so low that it's almost negligible. But obviously, there can still be some type of portfolio turnover. And Bogle is not talking about investing within retirement accounts. If you're investing within retirement accounts, such as IRAs, 401ks, and the like, then any tax implications are going to be deferred for the future. But if you're just investing in these taxable brokerage accounts, then passive management is going to do you a lot of good, and index funds are going to do you a lot of good in the fact that there is less turnover and you will realize more of your gains over the long term. Bogle makes the statement to really cap off costs being such a drain on returns. He says, beating the market before costs is a zero-sum game, but beating the market after costs is a loser's game. And that's just based on the data, based on the active management data. We see that active managers are not beating the market after costs. And so that is a big deal and a big part of the little book on common sense investing. And then he also talks about the idea of reversion to the mean. And so what he does is he compares the top 20 funds in each year with their records in the subsequent years, 1982 to 1992, and from 1995 to 2005. And he finds that the top 20 funds in each year had a subsequent average ranking of only the 58th percentile in the year after they were in that top range. And so basically what he's saying is short-term winning by a lot of actively managed funds does not repeat. He noted that funds whose records substantially exceeded industry norms tend to return to average or below. And it has been well noted before that Morningstar ratings of mutual funds are not indicative of what those funds are going to do in the future. If anything, they may tell you that that fund may underperform in the future if it has a higher ranking than another. And so that is something that's really interesting, something that Bogle finds, and something that he puts in this book that I think could be really useful and really good information for you guys. But he also finds that on the other hand, if we just buy an index fund and hold it for the long term, we'll most likely beat any of these other funds over the long term. They may win over the course of a year or 5 years, but if you take a 10, 20, 30-year time horizon, the passive funds are the winners. And so how do index funds compare to the others in the long run? How do they compare to active management in the long run? But if you compare 355 equity funds with the returns of the S&P 500 from 1970 to 2005, 60 funds underperformed the S&P 500. 223 funds went out of business before 2005. And so if you combine those two numbers, those 283 funds, that's 79.7% either underperformed or went out of business. And that's crazy because we think about mutual funds as long-term investments. And the fact that so many of them actually went out of business in that 30, 35-year period is pretty baffling. And then he found that 48 funds, 13.5% of the funds, just matched the performance of the S&P 500, and only 24 outperformed it. And so 6.8% outperformed the S&P 500. And so what does he find here? He finds that if you want to beat the S&P 500, only 6.8% of equity funds over that 35-year period actually did so. And far more went out of business than underperformed, overperformed, or matched the performance. Far more went out of business than any of those other categories. And so this is really, really baffling and shows you that buying the S&P 500 just as a whole, just buying the S&P 500 index fund can be the best move when it comes to your equity allocations. And then Bogle also takes a look at index funds versus financial advisors. And so in 1993, the New York Times started a test of the ability of financial advisors to outpace the S&P 500. And the editors asked 5 respected financial advisors how they would invest $50,000 with a time horizon of at least 20 years. The returns would be compared to the return of the Vanguard 500 Index Fund, which is Vanguard's S&P 500 Index Fund. And the result of this is that funds chosen by the advisors earned 40% less than the index fund. 40% less. That is a huge amount. That is a huge finding. And that really shows you that your advisor may not be adding the value that you think your advisor is adding. And the average final return of the advisors was $88,500, where that of the Vanguard 500 Index Fund was $138,750. Huge difference there. And one of the quotes from the book that Bogle says is, "You can outperform more than 80% of your fellow investors over several decades simply by investing in an index fund and doing nothing else." And so it sounds very boring. It sounds like a boring approach that Bogle is taking. But he's saying that if you are going to invest in funds anyway, then investing in index funds, investing in the boring ones, are actually the way that you are going to earn more than everybody else over the long term. And in the book, Bogle also talks a bit about ETFs. And Bogle is not a huge fan of ETFs because he believes in investing for the long term, and ETFs give way too much leniency towards being able to trade in and out over the short term. But he says that due to the structure of ETFs and tax regulation, when held for long-term, ETFs can be more tax efficient compared to the traditional index funds. In addition, their annual expense ratios are usually slightly lower than the traditional index funds. And so this is the positive, right? The positive is a little more tax efficiency and typically a little lower on the expense ratio. However, he warns that if you trade ETFs frequently, the commissions and the capital gain taxes will erode any advantage and may even overwhelm it. So that trading, that getting in and out, that being easily traded during the day, where mutual fund shares are only redeemed at the end of each trading day, is a way that you can get yourself in trouble. And Bogle does not want you to get yourself in trouble. So he's saying that if you are going to use ETFs, you can get some advantage from that. But those advantages won't be kept if you decide you want to jump in and out all the time. A specific quote from the book, he says, if you're making a single initial purchase of either of the two versions of the classic indexing, the SPDR, which is the SPY index fund, the S&P 500 ETF, or the Vanguard Total Stock Market ETF, at a low commission rate and holding them for the long term, you'll profit from their low expense ratios and may even enjoy a bit of extra tax efficiency. So again, those are his positive outlooks on ETFs, but obviously there is some negative there too that he talks about. And Bogle also dips his toe into the idea of sector ETFs in this book, and I'll just give you a little hint. He is not a big fan because of the lack of diversification you're getting there, and it's betting on a particular industry to do better than the rest or to do better than the total indexes as a whole. So he's saying that is a loser's game. Betting on the particular sectors that you think will do best is a loser's game. So stay away. So by sticking to an all market index fund, you avoid making bets and you receive a fair share of profit that is generated by the entire economy. So Bogle is not a fan of making bets. He is a fan of low cost, long-term investing. And he says if you are going to make any bets, if you are going to speculate, as we've talked about previously, then do it with 5% or less of your portfolio. And that's very similar to some of the guidelines that I have given you before. And so real quick, I just want to tell you that the things that are in this book go right along with what I believe. Do I believe that you can buy individual stocks for the long term and make a lot of money doing it and make good returns if you have the proper mindset and do the proper research? Of course I do. But I believe for the vast majority of people that passive investing is the way that they should go. Like I said, most of mine and my wife's investments are in passive index funds. Why? Just for these exact reasons. Why would we be trying to pick funds that are going to beat the market? Because most funds don't. And not to mention, I don't want to invest in funds that are going to go out of business over the long term. I want to invest in funds that are going to stay in business and that are going to provide me with good long-term returns that I can say, hey, I made the best returns I could over the long period of time without having to take a flyer on any particular actively managed fund that I just don't know much about. And actively managed funds look so much like each other, and it's so difficult to determine if one portfolio manager is going to do far better than any other that it's a toss-up, really, if you're going to try to choose an actively managed fund that will beat the market. So why take the toss-up? Why not take the guarantee? Why not take those long-term dividend yields of the market and the long-term earnings growth of the market and just take it with low costs and low commissions and low expense ratios and just move right along? So the Little Book of Common Sense Investing is one that I would say that any young investor should read. Anybody who is trying to get into investing for the first time should read, or anybody who doesn't know much about index funds or doesn't know much about ETFs, or anybody who's just trying to gain knowledge when it comes to investing should definitely read this book as one of the first few that they read. And you'll get a really good education on funds. You'll get a really good education on costs and tax efficiency and the S&P 500 and how to keep up with the market over the long term. Again, this is not The Intelligent Investor. The Intelligent Investor talks a lot more about individual stocks, and I'm perfectly cool with that as well. As I've told you many, many times, if you have the proper attributes to invest in individual stocks, then I'm totally cool with that. And The Intelligent Investor provides us with some fundamental things that Bogle does not in his book. But this is common sense. These things are straightforward. It is a very, very easy read, and you can get through it in a relatively short amount of time and come out on the other side knowing a lot more about investing than you ever knew before, and understanding how to, in practice, actually go and invest on your own and make money and build wealth over the long term. Jack Bogle was far before his time, but the principles that he lays out and the information that he lays out is timeless. And so pick this book up. Again, this is not an expensive book to pick up, so you can pick it up on Amazon, and it's at most major bookstores as well. So pick up a copy of the Little Book of Common Sense Investing, and you will not regret it. It goes for young investors, old investors. Sometimes we just need to hear the facts, and Bogle lays them out in this book. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below if you haven't done so already. If you're listening on Apple or Spotify podcast, then be sure to subscribe and leave me a review. Follow me on all the major social media sites at MNO with Dylan. And if you need somebody to help you stay accountable to a financial plan and help you create a financial plan that will work best for you, I can help you do that. Just go to my website, www.MNOwithDylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about another book that you should read in 2021, and that is Stocks for the Long Run by Jeremy Siegel, and we'll dive into what he has to say in tomorrow's episode. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.